Hi, I'm Marie Jacobs from Live Sotheby's Realty, and I have with me Brady Mullen, who is my financial genius person that I'm working with. And we're really excited. We're just going to take like 10 or 15 minutes to explain this concept that I learned from Brady. And I'll just kind of give you the overview in layman's terms, and then he's going to give you the financial benefits and show you one little graph that's going to help you understand. But when you invest in real estate, you have three areas of return and growth, right? You have appreciation. So you buy the house, it appreciates. So over a period of time, the house is worth more. You also have cash flow because you're going to rent that house out, and that rent is going to cover your mortgage payment to the lender. And then you have a tax benefit. So Brady has this great way of explaining what it looks like to look at just a $400,000 or $500,000 house and take into account what this looks like moving forward a few years. So I'm going to let Brady take it over, and I will ask some clarifying questions as we go through because he's so smart. Sometimes I don't get it all.
Thanks, Marie. Yeah, so what I want to focus on here is the appreciation and combined with the leverage. And often in real estate, we talk about leverage. What we're talking about with leverage is the loan, getting a mortgage when you invest. Of course, you don't have to do that. You can pay cash, but they call it leverage because it boosts your returns when you're using other people's money to make money. So people often focus on the cash flow, and cash flow is not unimportant. Cash flow is important, but often the appreciation and the leverage gets overlooked at how important it is because it's the most important piece. It's where most of the returns come from. So I'll show what I mean by that real quick. So let's imagine that this is a $500,000 property and your down payment is $100,000. Now, if you're thinking of investing in the market, like the stock market or any other investment, you don't think of your investment as the value of the asset, or maybe we do that, but only because we're not leveraging the investment. But your investment here is only $100,000. You are controlling a $500,000 property, but your investment is $100,000. Now look what happens in just 1 year if that property appreciates by 5%. So the debt is automatically getting paid down because that's how mortgages work. And this is straight from the amortization tables. So within 1 year, the mortgage will go from 400,000 down to 394 in a little bit. But if that property appreciates by 5%, that $500,000 asset is now worth 525,000. So not only did the debt get paid down, making your equity position a little bit bigger because the debt got paid down a little bit, you also get all that $25,000 of appreciation on the upside. So you've turned a $100,000 investment into about $131,000 investment in 1 year, even though the asset only appreciated by 5%. So you got about 31% return on your money in the first year. Now, if that happens again, that 525 becomes 551, not 550, because these are compounding things. So it's 5% of 525 now, not the original 500. So now within 2 years, your debt has been paid down to about 388,000, and the appreciation is about 51,000 and some change. So now you have $163,000 investment in only 2 years if the asset appreciates by 5%. Now, I don't know if it'll be 5. It might be, heck, we've seen years in the recent past that are like 15 to 20. But 3 to 5 is average across the nation. It's a little higher than that in metro areas, a little lower in rural areas in general. But if the asset only appreciates by 5%, you've turned a $100,000 investment into $163,000 in just 2 years. Now, remember here, I'm not including any of the tax benefits that you receive, because you get a lot of deductions when you do this. And I haven't included any cash flow. I'm assuming that all the revenue that you get in from the rent is being paid to the mortgage and maintenance and stuff like that. And that may or may not be true on an investment that you purchase, but I'm just isolating the appreciation and the debt pay down on this example to show how meaningful it is. And it often gets overlooked because people are focusing on cash flow. And again, I'll repeat myself, cash flow is important, but equity is a bigger piece of where the returns come from, especially if you're using a loan. So in the third year, that happens one more time. Sorry, go ahead.
Yeah, I think that it's important to note also that, you're using a $500,000 property, which we can get in our market. And when you have new buyers who don't think that I mean, not everybody's going to have $100,000 to put down, granted,
Sure.
but some people will, and you don't always have to put $100,000 down. But looking at this and looking at a very conservative 5% appreciation, we're seeing a huge amount of equity growth against that, whatever that down payment is that you put in. And really, I just did an analysis on one of my properties for a client. They've had it for 3 years, and they've got 10% equity growth in just 3 short years. And so they earned on a $487,000 property, they've earned $150,000 in equity.
Yeah, that's
and they're
great.
getting ready to sell. I mean, that's a huge amount. That's like getting an extra $50,000 a year in income. And then when you go to sell it, what am I going to do with this money? Either buy another one, buy 2,
Yeah, good point. So if we looked at a 5% appreciation example, but if you put 20% down and the property appreciates by 10%, so it goes from 500 to 550 in a good year, that's a good year.
Right.
But that means that that's a $50,000 increase in the equity of that property, because it's 10% on the value of the property, which was $500,000. So if that 500 goes to 550, your $100,000 investment went to 150 plus the debt pay down, which was about 6,000 in that first year. So you're talking about a 56% rate of return on your original $100,000. Now, I wouldn't buy something today and expect that tomorrow, but what I'm saying is, like, the mortgage is leverage. That's why they call it that. You just get, for every dollar that increases on the equity, you're getting a better return on your original investment, because the percentage of increase is based on the value of the house, not the value of your investment. That's why they call it leverage.
And I think that's what people don't understand, when they're new at investing in real estate. I didn't really get that when I was new at buying my first house and what it was going to do. And then when you go to sell it, you go, holy smokes, I got all this money here. I can buy 2 rentals. And so the sooner you start that, the sooner you get to that point, because in 3 short years, and as a matter of fact, I've got another client, and I know I've talked to you about my client, Will. He was buying his first condo and it was $317,000. And that was 2 years ago. And he now has $90,000 in equity. He didn't even know if he could afford the mortgage on that. And now he's got $90,000 in equity, and he wants to get a HELOC and spend that money buying his second condo, because now he has confidence. And the guy's 30 years old. I mean, start this early, right, Brady?
That matters a ton. We have more content on why starting as early as possible makes a lot of sense. Basically, what it means is, if you wait a day, you're not giving up what you've lost between now and tomorrow. You're giving up what happens at the end when those things have compounded. It's very powerful.
It's great. Well, thanks for your time. This was so educational, and I'm sure our viewers are going to love it. And if anyone wants to follow this more or get more information, just let me know. Marie Jacobs at Liv Sotheby's Realty, and my number is 303-919-4122, and you can text me there too. Thanks a lot, Brady.
Thanks, Marie.